There's a challenging trend happening with long-term care insurance. So if you have long-term care insurance or are on the cusp of managing this risk, I'll give you an update and a trend, what you need to be aware of, that and more. Coming up. My name's Mike Bernard. I'm the host of the Wise Money Show. I'm also one of the certified financial planners right here at Korhorn Financial Group. Make sure you hit that subscribe button, turn on notifications, and smash that thumbs up button. All right, so there's 5 main areas of risks that within your financial plan, you've got to decide, how do you want to manage these risks? Do you want to live with them? Do you want to just reduce them? Do you want to transfer them? And typically, transferring the risk involves getting some sort of insurance, exchanging a little bit of dollars to protect the big financial risk. And those are, well, if you pass away prematurely, that's life insurance. Prematurely, it's all premature for all of us, but depending on your financial goals, your financial needs, that's one. Number 2, you cause an accident and you damage property, or you have liability from that, so that's home and auto insurance. Disability insurance, that's if you are in your working years trying to earn an income and you're unable to work because of a health reason. Disability income replaces that income. That's third. Fourth is health insurance, and that is if you get injured or you're unwell, you've got expenses that could, you would have to help you recover. That's what health insurance is there for. But then there's this long-term care, and I'm doing that one next to health insurance, because what if you have a health situation where you are where you have health needs, you need assistance, and it's not assistance that will help you get better, that will restore your health. It's really just to maintain your health. Things are unfortunately unable to get better. And that's where long-term care services fit in. And health insurance doesn't cover that risk. They cover a little bit. They cover a couple days right at the beginning, but once it's determined that, oh, listen, you're not gonna get better. I mean, things are going to continue to deteriorate, and in your current state, you need help with just the basic activities of daily living. Health insurance stops covering that. It doesn't cover that. Medicare doesn't cover that either. Medicaid would, but in order to cover or be eligible for Medicaid, you can't have really any income or any money. And I'm generalizing there, but it's not much, okay? So that's why long-term care insurance is one of the 5 major risks, or the risk of you needing long-term care services, one of the 5 major risks that you need to tackle with your certified financial planner. Now again, you might, working with your CFP, say, you know what, that risk is there, but we don't feel like it's a big risk that we need to manage here, so we'll just live with that risk. Or we can absorb that risk because we've got other income in place, and if we needed care, we've got sufficient income or assets that we could cover the cost of care. That's great. But if you need to, or you feel it's appropriate to cover that risk by getting some insurance, then you would get long-term care insurance. And unfortunately, there's been a challenging trend, and it's creating a decision that many of you need to make. Long-term care insurance is where you're getting specific insurance that covers this risk. If you're unable to do at least 2 out of 6 activities of daily living, or if you have cognitive impairment, so Alzheimer's, dementia, that sort of thing, then you've got a specific policy that helps cover the cost of needing assistance. They usually do it, well, there's a deductible, so 90-day elimination period or 180 days. So once you need care, you've got to cover the first 90 days. But then your policy steps in and will cover a certain amount per day, $200, $300 per day, $100 per day, something like that. Then with a maximum, where, okay, they'll cover that expense for approximately 4 years, or until this pool of dollars is depleted, which will take 2 years or 3 years or something like that. And typically you can have it cover both the nursing, if you go to a nursing home, but really important to us is still that it also covers at-home care, because most people want to delay going to a nursing home as long as possible. You're going to do home care first. And so an insurance, a long-term care insurance policy will cover those things. And in the past, if you've worked with the CFP, or you're doing so right now, and you're managing their risk, and you get this long-term care insurance, ideally it's set up like life insurance, where there's a premium, there's a cost that you pay every single year, and ideally that cost is supposed to stay the same for the rest of your life. okay, that the actuaries have built in all of the projected costs, and for you, this cost should be the same every single year. But with all insurances, and life insurance as well, most people think level term, I'm going to pay the exact same. Well, that's how it's supposed to work. And there's enough history and data there that actuaries are pretty good at assessing that and coming up with the right number. But long-term care insurance, this risk and the insurance hasn't been around for that often. And so they're able to increase, those prices could change if they actuarially come up with, yeah, we've been undercharging and here's the proof, and they take that proof and they give it to your state insurance commission, and the insurance commissioner says, yeah, you're right. You're going to have to pay more, or they can charge you more, and then they pass that bill along to you. Well, guys, that's been the trend. More and more people that have had long-term care insurance in place, they're getting these notices from their insurance company saying, listen, your price is going to go up for the same coverage. So you've been paying this amount for the coverage, and you're going to, the price is going to go up to this amount over these next couple of years for that same amount of coverage. And with that notice, they give you a choice, and you've got 3 choices, okay? And that's a big financial decision that a lot of folks are reaching out to us saying, well, what should I do? So what are those choices before we get into what should you do? Number 1, well, just pay the higher amount. Your coverage stays the same, you've got the same benefits, you just now pay more, okay? That's option 1. Option 2, and they'll usually give you a few different variations, but option 2 is basically change your coverage in some way. And change your coverage typically means reduce your coverage so that you continue to pay something close to the same that you've been paying, or maybe even a little less. So option 2 is reduce your coverage. And then option 3 is stop paying. And by stop paying, you get a paid up policy that offers a little bit of benefit based on how long you've had the policy in place. So those are your choices, and people are reaching out and saying, what should we do? And guys, so what should you do? This is a financial planning question. This is a financial planning question because emotionally, here's what I know. Emotionally, you don't want to pay more. I don't want to pay more. I don't want to pay a single dollar more than I absolutely have to for insurance. I'd rather have those dollars going towards financial goals, whether those are future goals or current goals. I don't want to pay for insurance. Okay, so emotionally, I don't want my policy to go up. But then logically, you've got to wrestle with this. The reason the premium's going up is because that insurance turned out to be more important than the actuaries originally thought. More people are using the insurance, and it's costing more than what people originally thought. So the reason that you got the insurance in the first place is actually validated. Validated is more important, which is, that's what the actuaries are coming to the state commissioners, insurance commissioner, and saying, listen, we should have been charging more from the beginning. This insurance is more important than we originally, even more valuable than we originally were led on to believe. So emotionally, you don't want to pay more, but logically, you've got to say, yeah, this insurance is more important, so I need it. So what do? First, work with your CFP. And if you got this insurance in place and you're not working with the CFP, now's the time. Now's the time to do a full comprehensive financial plan and take a look. Well, listen, could you live with more of the risk? Meaning, should you take that second option and reduce your coverage a little bit? Or do you need to apply the logic here and listen, you need to just pay the higher amount, and financially you can afford to do so. I know you don't want to, but the coverage that you get, the specific coverage is, has certain partnership coverages in place, and that's a topic for a different video, but you need to keep the same amount. Work with your certified financial planner. Now, in doing so, if you have, since the time you originally got the insurance in place and right now, have additional forms of income, or your assets have grown significantly, and you take a look and say, well, listen, if we role play this and we needed assistance and it was going to cost $8,000 a month, we've got enough income to cover that. It might be where you're okay reducing your coverage or going with option C, where you just stop the coverage and just get this paid up amount. The thing that I would caution you on with jumping to that conclusion without working with the CFP is, from what we've seen, if you need care, if you don't have insurance in place, you'll likely delay farther than you should getting a professional involved and actually starting to pay for care. I mean, I went through this in real life. I mean, by the time my family member I got home and we had found out that he was trying to reheat his dinner for the 4th time in a microwave with a fork on the plate in the microwave. We had realized that we are well past the time where he needs care. He needs care. This is so if you don't have the insurance in place, then more than likely you're going to cut corners on care, and beyond the time when you should, because the cost is so significant. If you have the insurance in place, you're more likely to get a professional engaged at the right time. So to me, work with your certified financial planner, make a wise choice as to what adjustment you need to make, whether you just adjust what you're paying and pay more, or whether you adjust your policy. I would not jump to the conclusion that you should just cut the benefit altogether. But this scenario, you've got to work with your CFP. If you haven't yet solved or addressed how you're going to manage that risk of needing long-term care services, that in and of itself is a reason to work with the CFP. The risk is real. The cost is, the financial risk, if something were to happen to you, it's extraordinary. It's something that could be so expensive, it could punch a hole in your financial ship below the waterline. It's something you're going to want to work with your CFP on to see how a wise way to approach this risk for you. So work with your CFP on that. If you don't have a CFP on your team, you can contact one on my team. Find us online, Korhorn.com. That's Korhorn with K, wisemoneyshow.com. You can find us there as well, or give us a call, 574-247-5898. All right, there you have it. Go out and take your next wise step in your financial life.